Hi there, welcome once again to the wealthcoaching.ch studio. I'm Ben Jones. Alongside us once again for a general market overview is Osmond Plummer. Osmond, thank you very much for joining us.
My pleasure.
Now, if we look at the overall headlines at the moment, a lot of them are focused around the political tensions, both with the fighting in Ukraine and also with Gaza. In terms of market reaction, are things remaining relatively muted? And if so, do you think it's going to take an escalation of the tension for the markets to take notice?
I think at the moment you have markets all but in a form of denial. You have had over the last few years a fairly messy economic period for markets and so forth. You now have stock markets at higher levels than they were in 2007. And for most market participants, it's not in their interests to rock the boat. Let's pretend this isn't happening or there's no major consequence. It will all be all right in the end. If there is a major escalation, and that could happen realistically in Ukraine at any point, market reaction could be significant, swift, and quite dramatic. But at the moment, nobody has much of an interest in calling that. So I think markets will remain relatively stable. If there is a significant development, that may have a significant impact. But at the moment, players don't want to consider that.
Now, overall, would you say that we are currently in bubble territory? And if so, then what particular asset classes?
Bubbles are always quite easy to identify but difficult to call. You can say this is overpriced, but it can carry on being overpriced for quite a long time. There are certain areas where I would be extremely wary. One would be major city real estate, London in particular. London property prices have been increasing consistently out of whack with the rest of the country. I'm also personally a little concerned with the US stock market. You have levels significantly higher than 2007, as I said earlier, and I don't see profitability and revenues that justify those levels. My current favorite bugbear, if you like, is the equity for Twitter, which is trading at a sensible price, but Twitter has no positive revenues. Profits, it has revenues, it has no profits. And I don't see justification for a lot of the prices that we are seeing. You also have reasonably mature companies trading at 28, 30 times earnings. These are levels that are not long-term sustainable to my mind. So I would be very wary of equity markets in the West at these levels.
Okay, and finally, if we can discuss FATCA. Compliance has been going down recently as the IRS announced a transition period. So would you say it's still the better option to keep your money in a US bank simply because of ease?
I think that depends very much on who you are as an individual. If you have no connection with the United States economically, and you have no potential future connection economically with the United States, it makes very, very little difference, because you should not be subject to any of the requirements of FATCA, save for being noted on a document. If you have potential connections with the United States, it's almost certainly better to keep your money with a US registered entity, whether it's an SEC controlled entity of a Swiss bank or whether it's a US entity itself, just because then it's clear, it's concise, it's very simple, all the reporting will happen. FATCA is a massive piece of legislation. You talked about a reduction in compliance. It's not so much a reduction in compliance, it's just that everybody has started to realize quite how much work it's going to involve. And there are simple practical terms that say, we haven't got enough man hours to do this in the timescale. So there are delays being allowed to try and get people to comply, given the vast amounts of data that are going to happen.
Osmond, once again, thank you very much for joining us.
My pleasure. Thank you.
And thank you for watching. Do make sure you keep clicking back to wealthcoaching TV as we bring you plenty more updates and exclusive interviews. Bye for now.